Today, we're diving into a topic that's not only important, but also a bit of a game changer for anyone planning their financial legacy. Here's the headline, one we've heard a lot of since the budget announcement in October 2024. Pensions will be subject to inheritance tax from 2027. This is a major shift from the current rules, where pensions can often be passed on free of inheritance tax. So what does this mean for you, your family, and your estate planning? Is your pension still the golden goose of tax efficiency, or is it time to rethink your strategy? To break it all down, we're going to walk you through a case study. We'll take a look at how this new rule could impact John and Angela, a couple with £900,000 estate, and what their beneficiaries might face under different scenarios. Estate planning can feel overwhelming, especially with all the jargon and rules. That's why we're here, to make it simple, clear, and actionable. So let's unravel the mystery of IHT and how the new tax rules could affect your pensions. First, let's quickly review the basics of inheritance tax, or IHT. In the UK, IHT is charged at 40% on the value of an estate above the nil rate band. Currently, the nil rate band is set at £325,000 per person, with an additional residence nil rate band available in certain circumstances. Traditionally, pensions have been seen as a tax-efficient way to pass on wealth, since they can currently be passed on free of IHT. However, starting in 2027, pensions will also be subject to IHT, significantly changing their role in estate planning. It's important to note that if the owner of a pension dies before the age of 75, the beneficiary can access the pension without incurring income tax. If the donor dies after the age of 75, the beneficiary must pay income tax at their marginal rate on any withdrawals. ISAs, on the other hand, are subject to IHT, but do not incur additional income tax for beneficiaries. To illustrate the impact of these changes, we'll examine a case study involving John and Angela's estate. Their £900,000 estate is split between pensions and ISAs, and we'll analyse 3 scenarios to determine how much IHT and income tax their son, Adam, a basic rate taxpayer, will pay. Here's the scenario. John and Angela are a married couple with a £900,000 estate comprised entirely of pensions and ISAs. John passes away first, leaving everything to Angela, which is tax-free due to the spousal exemption. Angela later passes away at the age of 75 in May 2027, when pensions will also be subject to IHT. The entire estate is left to their son, Adam. As John left everything to Angela, his nil rate band is retained in full. The executors of the estate are therefore able to use both Angela's and John's nil rate bands to reduce the value liable to IHT, a combined nil rate band of £650,000. We'll explore 3 scenarios where the estate is divided differently between pensions and ISAs. Assuming Adam withdraws the full value of the inherited pension over a number of years, keeping his income tax rate at 20% throughout, we'll calculate the IHT and income tax liabilities in each case. Let's start with the first scenario. In the first scenario, the estate is evenly split between pensions and ISAs, with £450,000 allocated to each. Let's take a look at the numbers and see the IHT due and Adam's income tax liability. The ISA portion of £450,000 is subject to IHT after applying the £325,000 nil rate band. This leaves £125,000 subject to IHT, resulting in an IHT bill of £50,000. The pension portion of £450,000 is also subject to IHT. After applying the same £325,000 nil rate band, shared across both pensions and ISAs, another £125,000 is subject to IHT, resulting in an additional £50,000 IHT bill. As Angela died after the age of 75, Adam will pay income tax on drawings from his late mother's pension. As a basic rate taxpayer, Adam will pay 20% income tax on this withdrawal, amounting to £80,000. The total tax liability in this scenario is £180,000. This leaves Adam with net proceeds of £720,000 from the £900,000 estate. In the second scenario, John and Angela preserve the value of their pensions prior to their death, assuming this would be a more tax-efficient approach. As a result, the estate is weighted more heavily towards pensions, with £600,000 in pensions and £300,000 in ISAs. Note in this scenario that the available nil rate band is applied proportionately to the ISA and pension accounts, based on their value. Here's what happens. The ISA portion of £300,000 is subject to IHT after applying the proportionate nil rate band of £216,000. This leaves £83,000 subject to IHT, resulting in an IHT bill of £33,000. The pension portion of £600,000 is subject to IHT after applying the remaining nil rate band of £433,000. This leaves £166,000 subject to IHT, resulting in a bill of £66,000. After the deduction of IHT, Adam will also pay 20% income tax on the £533,000 pension withdrawals, which amounts to £106,000. The total tax liability in this scenario is £206,000. Adam's net proceeds in this scenario are £693,000. Finally, in the third scenario, John and Angela were forewarned about the changes in pension taxation. As a result, the estate is weighted more heavily towards ISAs, with £600,000 in ISAs and £300,000 in pensions. Let's look at the outcome. The ISA portion of £600,000 is subject to IHT after applying the proportionate nil rate band of £433,000. This leaves £166,000 subject to IHT, resulting in a bill of £66,000. The pension portion of £300,000 is subject to IHT after applying the remaining nil rate band of £216,000. This leaves £83,000 subject to IHT, resulting in a bill of £33,000. Adam will also pay 20% income tax on pension withdrawals amounting to £53,000. The total tax liability in this scenario is £153,000. Adam's net proceeds are £746,000. When we compare the three scenarios, it's clear that the way an estate is divided between pensions and ISAs has a significant impact on the total tax liability and the net amount Adam receives. Here's a quick recap. In scenario 1, with an equal split in pensions and ISAs, the net proceeds of the estate following a full withdrawal from the pension amounts to £720,000. In scenario 2, with a greater weighting to pensions, the net proceeds are lower by £26,000, with an amount of £693,000 received. And finally, in scenario 3, with a greater weighting to ISAs, the total net proceeds are the highest out of the three scenarios, with an amount of £746,000 received. From these results, we can see the upcoming changes to pension taxation in 2027 makes ISAs relatively more attractive for inheritance tax planning in these scenarios. While pensions still offer tax benefits, the inclusion of IHT reduces their overall efficiency for passing on wealth. So what's the key takeaway? With pensions becoming subject to inheritance tax from 2027, it's essential to reconsider how you structure your estate. Balancing your assets between ISAs and pensions could help minimize the overall tax burden for your beneficiaries. Pensions have long been thought of as the gold standard for passing wealth on tax efficiently. Depending on your circumstances, this still may be the case. However, from 2027, pension holders will be looking at these wrappers in a different light. If today's video got you thinking about how to arrange your estate and minimize the inheritance tax liability, don't stop here. Explore more strategies, ask questions, and stay informed about changes to tax rules and regulations. Estate planning doesn't have to be daunting when you break it down into manageable steps. If you found this information helpful, give this video a thumbs up, subscribe to our channel, and hit the notification bell so you don't miss any of our future content. If you have any questions or topics you'd like us to cover, drop a comment below or get in touch with us using the link in the description. Also, make sure to check out the Xenia Learning page, which we've linked in the description box. There, you'll find further reading materials, as well as a full transcript of today's video, so you can revisit any of the key points we covered. Lastly, always seek professional financial advice that's tailored to your personal situation before making any retirement decisions. Every financial journey is different, and a professional can help guide you in the right direction. Until next time, plan smart and prosper.